In the shadows of the global economy, trouble rarely announces itself. It creeps quietly. And tonight, the whispers are coming from Japan, where a debt bomb decades in the making just ticked a little louder. Investors in the United States are starting to sweat. Let's break down what's happening and what it means for your money. Japan's government debt has been enormous for years, over 250% of GDP, the highest in the developed world. But the real shock came when the Bank of Japan finally loosened its grip on interest rates. For decades, Japan kept borrowing costs near zero. Cheap money kept the system alive, but it also created a pressure cooker. When the BOJ stepped back even slightly, yields jumped. And when yields jump, the cost of servicing that mountain of debt jumps with it. That's the moment global markets noticed. Because Japan isn't just another economy, it's one of the world's largest creditors. Here's the part that has Wall Street pacing the hallway. Japan holds over $1 trillion in U.S. treasuries. If Japanese yields rise, Japanese investors suddenly have a reason to keep their money at home. That means selling U.S. bonds, which pushes American yields higher and tightens financial conditions across the board. Higher yields mean more expensive mortgages, more pressure on tech valuations, more stress on U.S. government borrowing, and less appetite for risk. It's a chain reaction, one that starts in Tokyo but lands squarely on Washington's desk. In the short run, expect volatility. Bond markets hate surprises, and this one hit like a flickering neon sign in a dark alley. You'll likely see Treasury yields spiking, the dollar wobbling, tech stocks pulling back, safe haven assets like gold catching a bid. Traders will call it rebalancing, but to the average investor it feels like turbulence. Long-term, Japan's shift signals something bigger. The era of ultra-cheap money may finally be ending. If Japan normalizes rates, other central banks lose their excuse to stay dovish. Global borrowing costs could drift higher for years. Governments, corporations, and consumers will all feel the weight. For the stock market, that means slower growth for high-debt companies, a premium on cash flow positive businesses, more value investing, less speculative hype, and a world where interest rates matter again. This isn't the end of the world, but it is the end of a chapter. Japan's debt bomb didn't explode tonight, but the fuse just got shorter. And in a global economy this interconnected, one spark can travel far. Stay informed, stay calm, and stay ahead of the noise.